Fund Show. I'm Neeraj Chan. Over the next 20-25 minutes, we'll talk all about mutual funds. Our guest today is Raghav Iyengar from Axis. And what we requested Raghav to do is not just today, but around the same time, every month for the next 6 months, we'll pick up a subject or a topic or two and try and probe his brains into what are the intricacies of that. So think of it as an educative series wherein you get to learn about what the category of funds may be, or what the concept is, and why is it that, or how is it that it evolves. Raghav, great having you, and thanks for doing this with us.
Thank you, Neeraj. Thank you again for the opportunity. I think lots of my life has been spent around educating investors, my partners. And I guess this industry is what it is because people have understood the subject of investments very much. So thank you very much personally. And thank you, Bloomberg. I think really great to be on the show.
Yeah, well, the data suggested the last time that I spoke to ICICI Securities that 1.5 crore Indians get admitted into the earning age, and all of those would be potential mutual fund investors. It will be great for them to understand what these categories are, right?
Absolutely.
So viewers, we're going to start off with two categories of mutual funds. It's a mutual fund show, so we talk mutual funds. And we've chosen the equity savings category, the equity savings scheme, and arbitrage funds. And these are, I think, Raghav, under the umbrella of hybrid funds, so to say?
Hybrid funds, yeah, absolutely, yes.
Okay, so what do we start off with? Should we start with equity savings, if you will?
Absolutely. I mean, equity savings is a beautiful name, actually, because the category is so beautiful as a name, I can't think of a better name. I mean, it's everybody saves. India is a country of savers. Everybody knows that. I think it's one of the fundamentally ingrained habits that we have inherited from our parents, our grandparents. So, and obviously, I think a lot of that savings now is going towards equity. So in that sense, the category name is absolutely wonderful.
Okay, it's one of the six offshoots.
6 hybrid, within the subcategories of hybrid funds. Yes, definitely.
Okay, yeah. So please continue. What is this category about?
It's a very, in some sense, it's a relatively unknown category. When you think of hybrid funds, what you really think about are the balanced advantage fund or the dynamic equity fund category, because that's obviously the really big. The category, as you know, Neeraj, is overall, if I were to look at hybrid funds as a total, it's roughly about 12-13% of the total industry. The industry just crossed, I think, is crossed 36 lakh crores now in the end of August, and this category is roughly about 4 lakh plus. And within that space, of course, you have the two mega categories, which is the erstwhile balanced funds, which are today called aggressive hybrid funds, and then of course you have the balanced advantage fund or dynamic equity fund. These are, of course, the two big superstars in the category. The equity savings category is actually a little, if I were to put it in a really layman's language, is like the younger brother of the balanced advantage category. So this category is treated as an equity fund. What that means is that at any point of time, the exposure to equities will be 65% plus. Now, the interesting thing about this category is that in equity, as you know, there are two types of ways you can put money. You can put money into regular equity instruments, and you have what is called arbitrage or futures, which actually which are in some sense like a fixed income instrument because they don't move. They are hedged into the portfolio. And the next category we'll talk about has a much bigger, this investment style has a much greater stay there. So what equity savings does is puts about 20 to 40% of the total 100 rupees that you have goes into regular equity scheme. I mean, regular equity stocks, right? These could be stocks of any variety. Now, that's another thing I'll talk to you about in a minute. And the remaining money, which is the difference between 65 and 20 and 40. And that 20 and 40 is subjective. That can be various fund managers, various fund houses have their various interpretations of how to manage that 20 to 40, 45. The difference of that goes in. So you get the benefits of equity taxation, but when market falls, you don't get that, the full impact of the market fall at all. And that we saw last year, if you remember, public memory is very short, but we're just about 18 months back. We were in the middle of possibly the greatest financial fall that I have seen in my life. I think the second highest in this, after a century, you had that kind of a crash. And this category actually fell very, very less. And obviously, when it went up, it did manage to catch up with the balanced advantage fund in that sense. In terms of its total returns over the last 1 year, the category has been in the region of 20% plus. So it's a good place for somebody who wants to step in for the first time. And at the same time, in difference between this one and balanced advantage is the balanced advantage guy can go between 30% equity to 80%. It's a fairly wide range. Here it's largely 20 to 45. So somebody is a little more conservative, says, hey, I want, or maybe somebody who's got money for maybe 2 years, 3 years, wants to earn a slightly better return than traditional fixed income instruments, wants to have that liquidity and get that tax benefit because this is treated as an equity fund. So you pay much, much lower levels of taxation. If you hold for more than a year, you just pay about 10%. If you take it out before 1 year, you pay about 15%. So much lower than your traditional, say, other fixed income instruments that come in here. So that's why, but it's a poor cousin of the balanced advantage category. What happened in this space, of course, is what the regulator has done is, as you know, it has given us all various buckets of schemes to put in. So there is an equity savings scheme, but within that scheme, fund managers can essentially, or fund houses can do essentially whatever they want. I mean, they can buy the debt portion, which is 35% typically. They can buy anything. I mean, you can buy 10-year, 20-year government securities. You can buy corporate bonds. You can buy any. There's no rating classification there. And same thing on the equity side. I mean, the 20 to 45% I said, it can be multi-cap or it can be flexi-cap and put money into small cap, mid cap, large cap and stuff like that. And that sometimes tends to, so you can't really, when you look at the category, you will see a lot of difference in the pay performances because everyone has their own style of managing. And I'm not saying it's good or bad. Like within the Axis fund umbrella, we largely invest in very, very large cap stocks in this portfolio. So it's actually mega cap portfolio because we believe the guy who's coming in here is a bit more conservative and may not have the stomach to take a small cap or a mid cap allocation. Same thing on the debt side. I mean, debt side, we are very, 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 we have a lot of exposure to AAA and above, but that changes fund house to fund. So this category, maybe 3, 4, 5 years back when it initially got launched, got a lot of excitement, but I think somewhere that asset allocation didn't work very well. And I don't think investors had a great experience. But yes, with the benefit of hindsight and obviously now with things becoming far more transparent in terms of what you buy, portfolios, disclosures, I think that way the regulators are doing an amazing job in making sure that all the information is available out there. I think there is far more awareness of this space. My view is that, yes, it's a poor cousin, but I think as time picks up, as markets keep rising, and as people want slightly more defensive portfolios, they'll probably swing over here into this equity saver category.
Okay. So where is it that you guys are at when it comes to these bifurcations? What percentage is in equity, and what about the remaining percentages? And why would you, for example, believe? I'm not asking you to advertise the Axis way of investing, but just trying to understand the rationale behind the way in which your construct would have been done, and how much is the industry varying on the other side, the non-equity side, for example.
So the fixed income part, Neeraj, is largely constant at 35.
35.
Everybody largely sticks to that space because that's the maximum allowed to make sure that it's a fund which gets equity taxation. So everybody's there. Within the fixed income space, there are people who have obviously lower duration. Some people have more credit. Within the Axis space, ours is largely very, very high quality credit and moderate duration. So we think, again, as I said, our view is that this is for an investor who's a bit more conservative, willing to give up a little bit of return, but wants to see slightly better protection, especially when drawdowns happen. Like what happened, may not be as extreme as March, but even drawdowns will keep happening. As you know, that's a feature of equity investing you can't run away from. On the equity side, we are largely we are between 20 and 45 typically. As of August 10, we were at about 41, and largely we felt and that was largely on the back of the fact that at Axis we felt that corporate performance is improving, markets are more buoyant, there's more liquidity, all the other reasons which you know about, and we beat there. But within that space again, we largely stuck to very, very large mega cap names. You know, typically the NSE 50 names is what you will find largely in the majority of it. And that's done quite well for us. I mean, in the sense, I can't complain. As I said, this is a fund where people should not be very comparative. I think people should go by their impression, their impression of the fund house actually. Don't get into individual, because if you start looking at, hey, XYZ gave X return and somebody else gave Y return, I think it's different because the styles of management Neeraj are going to be very, very different. Even though it comes under the same category, the way people run it, because as I was telling you this, there are no restrictions for the fund managers either in equity or in debt. So people could run very, very different philosophies here, and even though it could look it could throw up some very, very different results. So I think there it's more to do with the fund house, the risk management, the perception that you have of the brand, how the fund has done typically during market falls, actually, not more than market corrections. I think those are some of the factors that you should take into account when you're looking at this category. But it's a beautiful category. I mean, anyone who's got, typically now, anyone who comes in and asks me if I want to put money in equity, given where valuations are, I tell them you have to have a very, very decently long horizon. In this one, you could have a slightly shorter horizon. And anyway, anything you keep over a year attracts only 10% capital gains tax. So that's the other big advantage to you, say, compared to other investment avenues that you have. Yes.
What about the remaining 24%, Raghav? You 41% equity, for example, 35% fixed.
That goes into arbitrage.
Arbitrage, okay.
Arbitrage,
which enables the equity taxation.
Which enables equity taxation, but provide returns which are very similar to very short-dated fixed income instruments. So that's in some sense the balancing portion. So obviously, if you have a very, very, very negative view of markets or whatever, that 45 could come down to 25, 30. But then obviously the arbitrage portion increases from 25 to 35. So that's how it works. Basically. Yes.
And viewers, we'll talk about arbitrage funds in a minute from now. But Raghav, what kind of investors would you reckon, from a suitability perspective, should come into this equity savings category? And again, the second piece that I would urge you to kind of maybe speak about is that what percentage of, let's say somebody's starting off, because there are a bunch of people who are starting off, somebody's redesigning the portfolio in the current market context as well, wherein the valuations are elevated, etc. What's the percentage of allocation to a scheme like equity savings? And my last question on this, because a lot of mutual fund schemes tend to become very close to each other in terms of the nature, in terms of the returns that they deliver, etc. What comes closest to equity savings so that people understand the difference between the two?
That's a nice question actually, but I'll start with the first one. I think this one, as I said, you can have a slightly shorter investment horizon. Unlike, let's say, pure equity funds or aggressive hybrid funds or even balanced advantage funds, where I would even today, for somebody would say balanced advantage, I have 3-year money, I would say, no, you need to give it 5 years because these funds tend to do very well over a cycle. This one does not have that problem. So someone, even with a 2-3 year investment horizon, can comfortably look at it, of course. In terms of people coming in, the biggest question I get, and I'm sure you get that today, is that, sir, I want to invest money, but where do I go? I mean, market is at, so everyone's looking at the Sensex, and I keep telling them, don't worry about that. That's just a number. I mean, but when we get into economy and we get into prognosis, it's a very debatable talk. My view of economy and your view could be fundamentally very, very different. So
and both of us could be correct.
Both of us could be correct. Yeah, there would be periods of time where I will do very well. Like in August, my view would have been a hero view, but in July, your view would have been a hero view if you were slightly. So this product is beautiful for those kind of people there. Number two, if you're having some plan to get some sort of a regular income, you could do an SWP from this fund, especially after 1 year, because then it becomes equity taxation for you. So that's another interesting place. So, I have a lot of people, my dad's friends, who ask me, what do I do with it? And obviously I tell them that, this is a little more aggressive, but if you can hold on, maybe create some accumulation, and then maybe after 2-3 years, if you want to take out some money, this is a good place for you to take it out. So in that sense, it's a great solution orientation. Let's say I'm a parent, I have a child going abroad, I have educational needs. I can save up money maybe 2-3 years later, hopefully build up some accumulation, and then start withdrawing from that point of time. So it gives you the benefit of equity and also a little bit of stability of fixed income. And that's the whole idea of hybrid funds, right? Because you're investing in asset classes which are generally behave very, very differently at points of time. And hopefully that mix will give you a much better investment experience.
Sure, that works. Okay. Yeah. And you reckon, last question on this before we move to arbitrage funds, is there a category that comes very close to this? I heard you say balanced advantage, but I'm still wanting that clarity.
Balanced advantage in the past has worked very close because most fund managers, as you know, have rejigged their equity, especially in pricing markets. So obviously, but there, just remember, that's again a fund house view. You can technically go 30 to 80. So there are many fund houses who are yet reasonably aggressive on equity even today. So in that sense, Neeraj is a little more, it's quite a unique proposition. But the closest proposition to this would be BAF or dynamic equity. In terms of equity allocations, obviously the closest one that will come to this will be what I call the conservative hybrid funds. And that's a lovely category that I like to talk to you about. Hopefully next month we'll spend some time on that. But that used to be the erstwhile, if you remember, monthly income plans. There used to be a very, very mega category in the 80s and 90s and that. And that category does that. But yeah, in terms of equity allocations, that'll be very, very similar, because that one does about 25%. This one does about 40%. So in that sense, they're very, very similar. But if you look at it currently today, I think it will be the current equity allocation will be very similar to balanced advantage funds in the industry.
And last question: did I hear you say that the returns expectations should be between 15 and 20%, or am I mistaken? Sorry, did I hear you say that?
No. I said that. That's something that
you said that's the 1 year return.
No. I said the 1 year return was about 20% for that. Yeah, but obviously that's coming on the back of some fantastic equity performance.
What's the average return anticipation that somebody can do?
I think largely it's a tough one, Neeraj, because frankly, you don't know where equity markets are going in the next 3, 4, 5 years, right? But typically, if your view is that equity is at an 8-10% return asset class, I think this will give you somewhere maybe a couple of 3-4% around that. But yeah, it's predicting returns is a very dangerous occupation. You would know that better than I do. So
which is always my ears perked up when you said 20%. And of course, I mean, I know that you mentioned it from a perspective of the 1 year return, and wherein it has caught up with the balanced advantage fund, so to say. So yeah, that was nice. Okay, so Raghav, thanks. Any other point that we missed out in this? We largely kind of explained this well, but is there something that you believe we've missed out?
Yeah, I think the key thing here is to try and figure out how funds have done during a drawdown. And I think that's the important one in this category. I mean, don't just look at what people tend to do is they just tend to look at the category and then sort it by descending sort 1 year, 3 years and look at it. But as I said, the portfolios and the way style of managements are very, very different, because that's how the portfolios are structured. So, you have the same name, but it could be a very different underlying product for various types of funds. Unlike, let us say, a large cap or a mid cap or something where you have to follow a certain time. Yes.
Well, viewers, do note an important point. I think a lot of us or people tend to do this, which is sort the portal that you go to with the last 1 year returns, and if it's gotten very high returns, then it tends to be the natural course of action. I think that's fundamentally just a wrong thing to do. And Raghav has analyzed a very important point, not just maybe for the equity savings scheme, but generally as well. Just take a look at how some of the funds have done during drawdowns. It will help you. It will go a long way in trying to just give you some clarity. But Raghav, the second part of this conversation, and you mentioned that even in the equity savings scheme, there is some bit of money parked in the arbitrage category. What is this arbitrage category? Because a lot of people get told to invest in the arbitrage funds as a how do I say that, instead of parking money in a bank or a fixed deposit, so to say, and if you don't know when you will need it, but you might need it in the next 6 to 9 to 12 months, go and park it in arbitrage funds. Tell us what are arbitrage funds all about.
That's okay. I think that's a lovely question, Neeraj, because I think this is an under-explained category, but it's also a very popular category. Just to give you a sense, this category has got huge flows in the last 4 to 5 months, right? This whole industry used to be about 60,000 crores. As I'm talking to Neeraj, my last number I saw was about almost 110,000 crores. So it's practically doubled in the last maybe 5-6 months, right? Now again, here what happens again is that as you know, stocks, you can buy stocks in cash, you can buy stocks in futures, right? There's an F&O list, futures and options list. There's a price of a stock there. There's a price of a stock in the cash market. Sometimes there's a difference in the price. It will converge towards the end. Typically, these stock prices in the last Thursday of every month. That's what we call the settlement date. The exchanges have a settlement date. That's a monthly settlement. These prices will converge. But arbitragers are very, very smart fund managers who try and make a difference, try and capture this difference. It's very, very minute. But in percentage terms, it sometimes is 2, 3, 4, 5%. That's one part of it. Number two is, of course, the level of interest rates also determines the kind of spread that you're willing to get. Third is obviously the interest level in the market. So obviously the market is very bullish and enthusiastic as it is right now. You could get a very decent spread. There have been periods of time last year, to give you an example, where the spreads have just completely crashed. In fact, I think in 1 month they actually went negative, which is very rare, but it happened. I think, if I'm not mistaken, I think it was April 2020, if I'm not mistaken. But that, I said, is a very rare instance. So these are some of the factors that affect it. Now, Ordinary investors, even qualified investors, find it difficult to capture this. I mean, there's a very very robust large market dealing with this. In fact, this is if you remember the earlier days, the Badla system. Uh, this is in some sense the risk managed avatar of Badla. So chances of a failure here are very very less. So in that sense, yes, it's a much more carefully controlled system. Now, what makes this product very attractive? And of course, the same logic applies. 35%, it's a 100%, 100 rupee portfolio. 35 goes into debt. A part of that debt is put into margins because to be able to buy these futures, you have to have a certain margin. Those margins are largely debt securities. So part of it could be either FDs or government securities, very, very safe, essentially, which the bank will keep as a margin for you to be allowing to do. That's as per the exchange rules. It's a beautiful, well managed, beautifully regulated system, and that's in fact what makes the Indian equity markets very, very deep. In fact, the FNO market is many times the size of the cash market, right? But it's a tricky market. One needs to be careful about it. And this is something that I will tell all my viewers that the easiest thing is to get caught in an FNO business, but be careful because it's borrowed money. It's like you're pledging your house and buying equity with it. It could cut in very dangerous ways. Why has this category got so much money? One is, as you know, interest rates have come down. So if you go to a bank or you go to anybody else, the short-term interest rates are practically not there today. I mean, because as you know, there is a huge amount of liquidity in the system. The economy is just starting to pick up. Lending opportunities are there, but they will keep coming. But as of now, there's more money available than to be deployed. Right? So if I want to make a short-term thing, and I would, many people tend to put money in arbitrage for 3, 6, 9, 12, 9, 8, 9 months. Again, the same logic applies here, which I spoke in equity savings. Because these are treated as equity funds, there is a slightly lower treatment of tax incidence. So short-term capital gains tax is 15%, long-term capital gains tax is 10%. So if you look at the returns again, it's not very, very different. The highest performing fund, if you see in the category, would be like last year would be about 4%. It's all in that 3.5, 3.75 because the short-term rates are very pretty much clustered around a certain level, and those levels that are available in the economy, right? So, but why do people come here? Because let's say hypothetically you make 3.5%, and then you pay say 15% capital gains tax on that when you take out money. So effectively, you're landing up paying about 0.5% of tax. So you make 3% post-tax return. A 3% post-tax return for a say 3-month or 6-month investment is very, very, very good. It's almost like a 1.5% higher than what you pay. Where do these returns change? One is obviously, as I said, depending on those various factors, arbitrage levels could come down. That level gets determined at the end of every month. So it used to be, as I said, once upon a time, as high as 7-8% annualized, came down all the way last year to sub 2%. So the returns do fluctuate. It's not that once you put it in, that money is locked in forever. In that sense, it's very different from, let us say, any other fixed income traditional investment, right? But just the taxation, that's critical. Many people try and make one mistake is that they try and put very short-term money into arbitrage, which is a wrong thing to do. See, you do have volatility in this product. The volatility is at its lowest towards the end of the month. But if you try and do it right now, for example, there's a good chance that you may catch a positive mark-to-market or a negative mark, right? Because your spreads may be different during the middle of the month.
Sure.
Number two, this being an equity fund follows the same equity settlement cycle. So you will get your money in 3 business days. Unlike, let us say, a liquid fund where you get it in 1 day. Why am I saying liquid fund or ultra short-term fund? Because these are the traditional places where people go and park very, very short-term, right? And rightfully so. So if you keep money for 15, 20, 30 days, one is you could lose interest for those 3 days because you're going to get money after 3 days and it's 3 working days. So let's say if you redeem today, 3 working days is actually tomorrow, Monday, and Tuesday. So actually you'll get your money on Tuesday because Friday is a holiday because of Ganesh.
Sure.
So that's one thing that you need to be very careful about. Number 2, as I said, intra-month volatility you need to be careful about. But yeah, having said that, it's a nice category. As I said, it's seen a lot of flows. A lot of people, especially when they're confused about what to do with flows, either they they park it here, or they have a very, very short-term need, 3, 6, 9 months later, they know that money is going to come up. It's a great place to do it. But ideally, yes, you should try and redeem and put in money towards the end of the month, because that's the time when your spreads are the best, and that's the time you'll be actually able to figure out what the real rates are at that time. So, and this spread number is now easily available. You'll get a rough idea what it is. So it's not a guarded secret. You can get a sense. You Google it, you'll figure it out. It's not very, very difficult. Same thing on the debt side, Neeraj, like I said, because you can do whatever you want with debt. I mean, as I said, in this category, there are no stipulations as to buying AAA, AA, whatever you want. You can buy practically anything. But being a very, very short-term category, people, fund houses are aware that money doesn't stay for long periods of time. Most of us tend to buy very, very short duration assets.
Sure.
Debt also could be a bit different, because let's say if I have a AAA portfolio, let's say Axis largely buys, as you know, conservative debt, but somebody has a AA strategy, he will outperform that 30, 40 basis points. It's possible.
Sure.
So again, the same thing which you said, the same thumb rule. I mean, you do a descending sort and you see X being at say 4 and somebody will be at 360, 370. It's not relevant. You have to actually figure out internally what the fund house is actually doing to make that additional 20, 30 basis points.
Right? Got it. Okay. Raghav, one final question on this conversation, and that is, for what time periods is this suitable? I heard you say that people parking money in arbitrage funds for very short term are making a mistake. So what's the ideal investing duration if one is looking at arbitrage funds?
Ideally 3 months plus.
3 months plus running.
Ideally 3 months
up
plus.
to?
Yeah, ideally 3 months. No, see, there's no top end, because like I said, these are parking instruments. Some people have clarity on when they need the money.
No, what I just meant to ask you, sorry, before that, let's say if I have clarity that I want to invest for 12 months, then is arbitrage funds the right option, or should I choose other options? That's my question.
At this point of time, I'm a fan of other options, Neeraj.
Okay, got it.
I'm a fan of other options because I think, as I said, it's my view of interest rates. I think interest rates will, my guess is, given that economy is doing so well, will start going up a bit. That's the natural progression. So if I have 1 year view, then I might get something slightly better with a 1 year duration kind of a scheme. It is possible for me to get that kind of. Because the other thing which people tend to forget is that you also lose that additional days when you get it. Right?
Sure.
Again, this is my personal view, so I know I get a lot of dissent on this, but that's where it is. But what I mean, the end part is very easy. What I want to make very clear is don't put money for 15 days. I've seen that happen.
Yeah.
So people think that, wow, this is giving me similar. It's like it's a very safe instrument, like I explained the structure of it. So that way there's no problem. But people say, okay, with safety, it's very similar to a liquid fund. So let me put 15, 20, 30-day money. That I think is playing a bit with fire. You might get stuck, And the number two is, of course, so ideally 3 months plus is perfect. Obviously, if you keep it for more than a year, the same equity taxation rules kick in that you pay tax at 10%. Not at, because it's a long-term capital gains tax. And of course, if you take it out before 1 year, it's about 15%.
Very cool. Raghav, this was lovely. Thank you so much for coming and explaining these, and we look forward to talking next month as well.
Thank you. Thank you very much. Really look forward to that. Yes.
Likewise. Our pleasure is ours. Well, viewers, I'm guessing this gives you a good idea of what equity savings, as the name, and we've discussed this so many times, viewers, about what equity savings schemes are and what arbitrage schemes are. Now, Raghav Iyengar has given you a complete lowdown of what these are. But all of you must be wondering that while I know about this, what is it that I should do with these? What are the kind of options available within these categories as well? And to talk about that, and his view, of course, is Tarun Birani. Needs no introduction again, has been with us on the show a number of times and joins us again. Tarun, thanks so much for waiting by patiently. Just so we have a complete lowdown, Tarun, and maybe you were able to hear some of the bits that Raghav said as well. Is there very quickly 1 or 2 points that you want to add either for equity savings or for arbitrage funds? And then, of course, I would love you to tell us more about what are the options available and what should people keep in mind.
So, good evening, Neeraj, and I think I was hearing the conversation, and this entire equity saving category or these hybrid categories have been originated actually for a you go back to history, it has been originated out of approach for an asset allocation, right? We all have been, when there is a high bull market, everybody feels that equity is the only asset class to play, but that's not the correct thing. 90 to 95% of the actual long-term returns are generated because of asset allocation. So I think these categories or these strategies have a right fundamental approach to start with. But what I just want to address for this category called equity saver category, which you guys are talking about. One is this category again has been positioned more for retired people, conservative investors, people who are looking at low equity exposure in the portfolio, low risk, low drawdown in the portfolio. But again, when I was looking at this specific fund which you was talking about, it has high quality portfolio. The equity mix is into large cap equity. The debt mix is again into high quality debt. The arbitrage category again is a great way to get tax efficient return. But my big issue with this strategy is it is expense. The expense ratio of this product is at a normal equity fund. When you are putting a 40-45% into equity in a category, and the expense structure is at 2-2.5%, which according to me is not a very investor friendly product for at least the smart and savvy investor I am talking about. People who can't do the structuring themselves, I think it is a great product for them to look at, because they get a ready solution where rebalancing is happening, the debt equity dynamic allocation is happening, arbitrage is happening, debt is happening. But my disconnect is on the expense structure. For a larger sophisticated client, it may not be a great structure. I did a study on a portfolio which we did for a client for 2 years before, wherein we have put in 20 to 25% into a pure equity option and 25% into the dynamic asset allocation category, which has an option to move between 0 to 100% into equity, and the balance into debt category. The results compared to, let's say, this category versus that allocation was slightly 1 to 2% better alpha has been generated by that. So I feel for an investor who has the knowledge and the bandwidth, and maybe who has an advisor who can advise him to create a post-tax better experience, I think that could be looked at. Again, the debt structure, one need to stay for 3 years. That is very critical. If you go for 1 year, your tax efficiency goes away. So again, this product has been beautifully structured to give you a good tax efficient experience. But for a 3-year horizon, I would go for something like that structure, not for this kind of structure. Again, if you look at in the current environment, what are the challenges with this category? The arbitrage yields are again less than 4% as we talk. The spreads are lower right now, and the debt yields in the short term debt is also lower right now. So the returns which this category is going to make is largely because of equity. And tomorrow, let's say a 2-year, 3-year, you are putting your money at the top of the equity markets. Again, from a 2 to 3-year point of view, you should be ready for a very high volatility in your returns, because let's say your 60% of your portfolio is generating 4% return, and the balance 40% is flat. If it doesn't give you any returns, it is quite possible your return experience for 1-2 years may go bad. So you need to keep a 3-year horizon for this investment. Otherwise, you may not have a very great experience with this product also. So it is very critical to look at that way. Talking about the arbitrage category, again, it's a beautiful category, and as Raghav rightly mentioned, it is a very well-regulated system originated from the Badla system. And as we talk right now, the spreads are not great. It is less than 4% as we talk. But from a tax efficiency point of view, it's a great product. Anybody who has a 3 to 6 month kind of funds parking capability should look at an option like this, because the option in the short term debt are very limited as we talk right now. But again, this market is also, as we talk, is more than 1 lakh crores in the size total. So there are limitation of when so much money is chasing the yields, and the market's volatility is less right now. So you should not expect very high returns from this category also. Yeah.
Got it. Okay. So Tarun, just very quickly, before you give us some options as well, for somebody who's put in money into the arbitrage funds, and if that time period has crossed, let's say at the start of the year, say in January, somebody put money in arbitrage funds, what's the ideal time? I mean, should one keep it less than 12 months strictly because it's better to do it that way? looking at the situation right now, or how would you guys?
I think the maximum could be decided based on the market environment where you are right now.
Which is why the current market environment?
So in the current environment, I think since we have limited option, you have already completed money, stay invested. I would recommend to stay invested, not to get out.
Got it. Thanks. That was the answer I was watching for. And viewers, please do it depending on when is it that you've gotten invested into. But I think, as Tarun said, if you don't have too many other options which are lucrative enough, then maybe stay invested. Tarun, a couple of funds, and why do you like them in both the categories, if you will?
I think
again, this is a presumption that these are the categories that are available. Sure enough, I take on board your point that maybe there are other categories which are better. But if somebody wants to choose these two categories, what are the options?
So at this point of time, I want to share some categories which I feel one should look at the high equity market. I would rather look at a category which has a more dynamism to go from 0 to 100% of equity, which can help me protect my downside by 50 to 70%, and which can give me a 90% or 80% upside when the market goes up. So a dynamic asset allocation category is a category which I feel in the environment where we are in right now is best positioned in the current environment. That is one category. There is another one, not to go category is a small cap category as we talk. I feel small caps there is a lot of froth in that category. So I would strongly recommend to at this point of time to judiciously invest their money, or if you have made a lot of money there, start booking profits in that category, because that category I can see a lot of interest is building up right now.
Okay. So which is the alternatives to currently the equity savings? But if, like I said, if somebody wants to put in money in equity savings, what are the better funds to stay invested in or put fresh money in? Any thoughts?
So, as I told you, I'm a big fan of reducing the dilution in the portfolio. So one can look at a pure 30%, 25% pure equity allocation. One can go with a pure index option on the 25% of the portfolio. One can look at 25 to 30% into a dynamic asset allocation category, which has an option to go from 0 to 100%, and balance could be looked at into a mix of arbitrage and debt category. That could be a better allocation if one is able to manage that.
Okay, so but you're not advocating or not advising even a single equity savings fund, any which ways?
I feel it's a high expense structure, so I would rather go for the structure.
What about arbitrage, Tarun? Are there a couple of funds that you believe are good arbitrage funds?
Yeah, so I think more or less entire market arbitrage fund returns have been more or less in line. There would be hardly 20 to 30 basis point plus and minus returns. So one can look at any of the fund house in the arbitrage category. Maybe the top 10 are giving 10-20 basis point plus minus. So in that category, based on the current environment, one can select the arbitrage fund, and maybe one should be very careful about a 6-month horizon. That is very critical.
Fair call. Tarun, take a moment to thank you for joining in today. Really appreciate your time, and stay safe.
Thank you. Thank you, Neeraj.
My pleasure was ours. And viewers, thanks for tuning in to this leg of the Mutual Fund Show.